You have $12 billion under management.
Yeah, I started with zero, $30,000 in debt. All the active managers trying to beat the market, 95% of them failed to deliver even a market return. So it's like a bunch of orangutans flipping coins or throwing darts to pick your stocks. I invested $30,000 in my business initially. I just recently had it valued for $250 million. We're at $12 billion. I want to be $24 billion. I want to help people fulfill their American dream, prudently invest their money, stop speculating and gambling. Focus on what's really, truly important to them.
Is there ever a possibility where the U.S. market just crashes and everyone's screwed?
It's not a matter of if, it's a matter of when.
What is one to do? Stay tight and buy more?
Well, the first...
What it is, Brad Lee back again with another episode of Dropping Bombs. Today in the studio, folks, I got a real treat for you, especially if you need to learn how to invest your money. Mark Matson is in the house. What's happening, Mark?
Great to be with you, Brad.
Folks, you guys may know who he is already. If you don't, at Matson Money is where you find him. MatsonMoney.com is his website. This dude's like a young Warren Buffett. Yeah? Would you say?
A little bit.
But you're definitely an investor. Mark's a founder and CEO of a $12 billion RIA called Matson Money. Was founded in 1991. He's an author of Experiencing the American Dream, which is a 6-time national bestseller, How to Spend Your Time, Money, and Energy to Live an Extraordinary Life. You've been around. Also, your book, Main Street Money, How to Outwit, How Outsmart, and Outinvest the Wall Street Bullies. You're also the creator of the American Dream Experience and the Matson Method, designed to help people reframe and improve their relationship with money. Dude, you got quite a few accolades here. You've been doing it for what, 30 years?
Yeah, I started my company up 1991, so it's 34 years when I started Matson Money. Young kid, 27 years old. Really fed up with the way that the financial planning industry worked. I had wanted to be a financial planner, oddly enough, since I was a little kid.
Why so?
Well, my dad was an insurance agent. And so I always idolized my dad and wanted to be like him, when I grew up. So I got a degree in finance and accounting, went to work for a big broker-dealer, Fortune 500 company, and was very disillusioned very, very quickly, watching all these people take my recommendations, which I also put my own money in, and then watch them get destroyed because of Wall Street and what they were doing with their money. And that's why I opened my own company.
Watch who get destroyed, the clients or your picks?
The clients, yeah. So
but when you started, how did you know what like you gave recommendations, they didn't take them? Why? Number one, what qualified you to make recommendations? Yeah. Your degree?
Yeah. Well, the way that the industry works is if you go to work for a broker dealer, is they're supposed to look at the experts and then they put the experts in front of you. And then you're supposed to pick from the experts. And these experts are supposedly people over the last 20 or 30 years that have been able to beat the market. So if the S&P was 10%, they tracked in at 13 or 14%. You mentioned Warren Buffett. So the idea was you then trust them with your client's money and that they're going to continue to beat the market going forward. And very quickly, I discovered that that was all a bunch of garbage, that they were Wall Street bullies, that stock picking doesn't work, market timing doesn't work, track record investing doesn't work. Yeah, go ahead.
Well, because I got a lot of questions because I am very green in the world of investing. So like me and probably thousands of listeners are going to need this episode because we're starting to make a little dough. And I always say, I've spent so much money over my life trying to impress people that if I had it back, it would be impressive. but it's not. No one remembers shit. Like I should have invested all that money. So I have a lot of questions. Now you just said ultimately that these Wall Street bullies, there's never a winner when you're picking and trying to time. Isn't there sometimes?
Well, there's a winner, but it's not anything that you can bank on.
So you might get lucky, basically.
So, for example, of all the active managers trying to beat the market over the last 20 years, 95% of them failed to deliver even a market return. No one can tell you. That's why you don't see a magazine that says, here's the guy that's going to do it over the next 30 years. You only see it in hindsight. So it's like a bunch of orangutans flipping coins or throwing darts to pick your stocks. Nobody knows someone's going to get lucky. That's true. But you don't get to know in advance who that person is, whether it's the Wall Street bully or whether it's you or any average investor trying to pick their own stocks themselves. So the market is extremely efficient. For example, large stocks historically have averaged 10%. Very few investors average 10% consistently. Microcap stocks have averaged 12% for the last 80 years. Very few investors ever make anything like 12%.
Why not? Why don't they just roll with the stock market?
Because there's human emotions. Now, some people are smart enough to figure out, well, wait a minute, since I can't beat the S&P 500, I might as well own it. And then they buy an index fund. But that's a very flawed answer to the problem too, because that index, the S&P 500, goes through very long periods of time, like from 2008 or through 2009, where it lost 50% of all its value. And most people, when that happens, they panic, they sell, they lock in their losses, and then they don't get back in until it's already at an all-time high.
Why wouldn't they just chill?
That's like saying, why don't most people get up in the morning and go work out for an hour and a half and then, have a cold plunge and actually take care of their body? It's because of human nature. Look, it's easy to say, I can explain the science of how to build a portfolio. What I can't tell people is the secret to staying disciplined for 30 years. That's the hardest thing of all to do, is the discipline of anything. So just telling someone how to build a portfolio is only half of the challenge. The other half of the challenge is instincts. Your instincts are always going to make you run away from things that are painful. They run towards things that are pleasurable. So when the market's down, people panic. They move out from instincts, their emotions, and then their biases.
Yeah, but you're talking about the market. So like the S&P. Historically, you can verify this. It's never been down over time. It's always went up.
It's never been down over time, but you got to stay in it the whole time.
I know, but that's my problem.
That's the problem.
Well, you would think that'd be common sense for somebody. So if I gave you, for example, $100 million and you said, hey, I'm just going to put it in the S&P. And so now I have $100 million and next 3 years I'm down to 30 million. Why? Because it's down 70%. That's the whole entire market.
That is the whole entire market.
So I would just sit there and wait, because historically, not Mark said so, historically, it's always gone back up. So it might be 10 years, it might be 15 years, but I'm always sure it will go back up. So if I just don't do anything rash, it's just a temporary down cycle.
Here's what I tell investors. The next 100% is up. It always has been, even since the Great Depression. The next 100% is up. But nobody can tell you what the next 20% is, whether it's going to be up or down. What happens is people in a cold state, in an analytical state, they will look at the numbers and go, yeah, I can handle that. I can lose 40% of my money and stay disciplined. That's not a problem. But that's hindsight bias. They can see that it came back the next year. You don't get that kind of hindsight when you actually go through real life.
When you're moving forward, you mean?
When you're moving forward, because it's not only that your money's down 40%, let's say in the S&P, but now every time I turn on the TV, there's some talking head saying it's going to get much worse. And now we have 2 wars. And now we have a recession. And now we have an inflation. And then you have talking heads saying you got to get out of the market because it's going to drop another 50%. So it's not just looking at a number and watching it go down. You have to also steel yourself, harden yourself against all of the information out there that's pushing you to sell. And then, God forbid, that you have a life emergency. Maybe your wife gets cancer. Maybe your child goes into rehab. Maybe you lose your job. Maybe you lose a house. So human beings, it would be great if they were, like you suggest, 100% logical, entities, but like Spock from Star Trek. But they're not. They're full of emotions. They're full of subconscious decisions. They don't even know why they do what they do. And so even knowing the science behind it does not ensure. It's like a diet. Everybody knows how to lose weight. You move more, eat less. Now you can buy huge books and hire a personal trainer and do all that shit. But the reality is the rules are easy, but they're hard to do. That's why we have huge epidemic in obesity. Following the rules isn't easy.
So that's how easy it is. Just follow the damn rules.
Well, if you, it's number one is you got to know what the rules are. And that's
the key right there.
And that you don't go to a broker dealer to find the rules, because they're going to tell you, pick the right stocks, try to get in and out of the market. And if you can't do that, find someone who got lucky in the past to do it for you. There's no academic science that says any of that stuff works. On average, you're going to lose 2 to 5% of your money per year trying to do it.
How do you explain day traders?
Well, what do you mean? How to explain them?
Well, they're just picking and choosing every day, right?
Yeah, a lot of them go bankrupt.
But a lot of them don't.
It's kind of like one of the things people say, well, I made money, so it can't be wrong. Well, that's like saying you go to Vegas and you bet $1 million on 35 black and you win. A thing can be imprudent and dysfunctional and sick, even if you get lucky. So just because somebody gets lucky doesn't mean it was a prudent thing to do. If you're trying to fulfill in your dreams and fulfill in your life, and you're out there speculating and gambling with their money, one of the things I do in my workshop is I help people focus on what their true purpose for money is. Very few people will say, my purpose is to speculate and gamble and hurt my family.
What do most people say?
They say things like create freedom for my family and for the people I love.
Isn't that the bottom line, though?
For me, it's a huge part of it. They'll say my faith. They'll say things like helping children, that have cancer. It's always about being of service and helping other people. I've never seen it come out where someone says, my purpose for money is power, control, ego, arrogance, and gambling. But that's, if you don't clearly define your purpose for your money, and I also call it the purpose for your life, the default position is gambling. You have to have a purpose big enough to want to actually learn how to invest right and then have the discipline to back it up. And that starts with purpose.
Is it too late for older folks like me?
No, it's never too late.
Because I need compounding interest.
Well, yeah, but you're 55, I think I looked up. Dude, you could have another 30 years. You could have another 35 years.
Is that enough time?
Oh, yeah, that's for sure enough time.
Is it?
That's a lot of time. Yeah.
It doesn't sound like it. It doesn't sound like it, does it?
I know. I'm 62, so I'm thinking.
If I said you only have 20 Christmases left, does that sound like a lot?
It's not a lot, but when it comes to a portfolio, building a portfolio and managing it, that's a lot.
What do you think is unrealistic for someone to believe that they can double their money every 7 years?
No, I don't think that's unrealistic at all. 10% rate of return that the S&P doubles your money every 7 years. So that's doubling your money in every 7 years, not unreasonable at all. Now, you won't do it every single 10-year period. Some 10-year periods, you might triple your money in 10 years. But the thing for investors is they don't want to just be in the S&P. Because the S&P, if you look at the U.S. market, has actually the lowest expected rate of return. They want to own microcap stocks. They want to own small value stocks. These are companies that are small, but have a lot of assets, but are very small value because they've been distressed.
Do you have to look at these charts in these companies?
You have to. It has to be looked at every day.
I mean, do you personally sit at your desk and look at these things?
No, I know I have people that do all that.
Did you in the beginning?
In the beginning, yeah. Yeah, in the beginning. Yeah, designed all the portfolios and then I work with a company, a large Fortune 500 company that helps manage the individual pieces of the pie. I build the models and then keep the models balanced, and we run algorithms and we run it every single day on the portfolios. So rebalancing is every single day.
Who gave you the first chunk of change? And are they still with you?
No, they're not. His name was Lynn Abrams. It was, I drove from Cincinnati to Worcester, Ohio. I did my first seminar in his living room. There were 12 people there. It was snowing like hell. I couldn't even get home. I was at a Red Roof Inn. I remember I couldn't hardly sleep that night because when I went to get in bed, there was a cockroach running across the floor. I was like, oh my gosh, this is terrible. But Lynn's since passed. But he was one of the first advisors I worked with.
No, who's the first person that said, "Here, I'll give you my money"?
I don't remember the individual person.
Because once you get money, then you invest it as an RIA, correct?
Right. That's
so you
right.
have to get someone to give you some first.
That's
Did
right.
you invest yours successfully? And then how do you start an RIA? Other than all the legal compliance and the regulatory shit, like let's say you're licensed and you're ready to go, how do you start it?
Well, first of all, you have to decide on what your investment philosophy and structure is going to be. And then you have to go out and you have to hustle. My marketing material was a yellow pad and an overhead projector. That was 1991. That was the state of the art as we got back then. And then I'd have to go out and talk to a ton of people, and I'd have to show them that what they were doing was broken. And I would do an analysis on their portfolio. And I would say, which we still do today. And we'd say, okay, here's how your money is put together. Here's the assets you have. Here's the categories you have. Here's the volatility you have. And here's the expected rate of return of your portfolio. And when we would do that analysis, we would inevitably find that they were taking way more risk than they thought they were taking. And their expected returns were way, way too low. And so then I would show them different mixes of assets that had higher expected returns with lower volatility. It's something called, academics call it mean variance investing, won a Nobel Prize. But what it means is whatever amount of risk you're willing to take, you should make sure that your portfolio is designed to get the highest rate of return for that amount of risk. And I would have to hustle, and I'd go out and I'd tell all these people. I also told my existing clients, because I remember I was at the broker dealer using active management, and it wasn't working. So the first handful of clients were my own clients that I had, had at the broker dealer, and I left the broker dealer, and then started my own RIA.
But someone had to give you money in the first place, yeah?
You mean to fund the company or to? Yeah,
I mean, you have $12 billion under management.
Yeah, I started with zero. I started with 3 credit cards, $30,000 in debt. That's how I started it.
And now again, if I were to look up your bank accounts and your investment accounts and your assets managed of other people's assets, not yours, but other people's assets, you've convinced X amount of people to give you their money to the tune of $12 billion.
$12 billion, that's right.
Which to me sounds quite substantial. Is that normal for an RIA?
No, it's not normal. It's easily within the top 1%.
So how did you do it?
Well, this is just a lot of hard work. A lot of hard work.
You got to remember back when you were 27.
A lot of hard work. And then I also teamed up with some of the best people in that I could possibly find. I didn't say, okay, this is just my idea. I'm going to start this at 27 years old. I went out and got the people. My dad always said, if you don't have credibility, borrow it. So I got together with Eugene Fama at the University of Chicago, Nobel Prize winner, Harry Markowitz.
Back when you were 27?
Mm-hmm.
Okay.
Dr. Harry Markowitz, also Nobel Prize winner, University of Chicago. A lot of the research we use to build the portfolios is from the University of Chicago. And they've won more Nobel Prizes than any other economics department in the world. And people like F.A. Hayek, Merton, Bob Merton, a lot of Nobel Prize winners out there. So when I started my own company, I realized no one's going to trust a 27-year-old kid. I'm going to go out and get these academics who I also believed I studied Markowitz in college. And when I read that chapter on Markowitz, I was like, this guy's got to figure it out. I mean, this has got to be the way the world works.
So you leveraged those guys' credibility.
That's right.
And then at some point, because that's what I was thinking, like, how'd you start it with 27 years old? If you came to me and I was some older, wealthy guy, I would have said, why you?
Yeah, well, which would have been a great question.
Yeah, but you've been doing it.
If it was me in my garage coming up with some formulas, that would have been a bad deal.
Well, again, I mean, obviously something worked.
Well, then you have, the way science works is you have a theory or a concept, a hypothesis. And then the only way you know in the world of investing if it's real is then you have to see what the performance is, the live performance, versus what the theory was. So then, so here's the theory, the first $100 million with my own clients. And then I started going out and showing other financial advisors how to do it. But if the numbers hadn't matched the research that we were doing, And that when we were telling people about how to diversify their portfolios and how we were going to build them and stay disciplined, if the numbers hadn't matched the research, then we would very quickly have gone out of business. And a lot of our RIAs do.
Where do you live?
I live in Scottsdale.
You have a big fancy house?
It's pretty fancy.
Do you live the lifestyle that one might expect or no?
Probably. I probably do live the lifestyle people.
Do you ever have investors talking shit?
Talking shit. I have advisors talking shit.
Yeah, but how about investors?
No, not really.
Because it's like, if I gave you all my money, I would want you to be successful financially, because that's why I would give you my money. The fact that you got 12 billion, that's like, I forget the bias they call it, but like, in other words, the herd mentality, like somebody's got to trust your ass if you have $12 billion.
Yeah, that's called herding bias.
Yeah, so I would give you money because of that. If your firm's been in business 35 years and you're managing, $81 million, I'd be like,
we're going to take a pass on that one.
Yeah, but 12 billion with the B.
Yeah, with the B.
That's a massive number. Is it all deployed always, or do you have a certain amount in the bank for liquidity?
Well, we obviously, two things. It brings up an interesting point. How do you verify if your advisor is legit? Because there's 30,000 RIAs out there. How do you know if you have one that's actually legit or not? And there's always con artists, there's prognosticators, gurus, there are all kinds of shenanigans going on in this industry in spite of regulations, because some of them don't follow the regulations.
Do they end up in jail?
They do, if they get caught in time. Some of them abscond with the money. So how do you make sure that doesn't happen? Number one is that you'd be shocked about the registered investment advisors that have no audited returns. They just make up hypothetical numbers and tell their clients, this is what we've done.
That should not even be legal.
It shouldn't be. No, it should. You're right. It shouldn't be legal.
So it is?
It is legal. It absolutely is legal. Very, very small percentage of RIAs actually have their audits of the returns. We do.
It's like when you do a personal financial statement. I could say this company's worth, to me, $1 billion, put it on my bank statement or my personal financial statement that I'm applying for a loan, and they can't say that it's not necessarily.
That's exactly the way.
That should be illegal.
It absolutely should be illegal. You shouldn't have an RIA that doesn't have audited review numbers that they can prove are verified. The other thing is you should never deal with an RIA that doesn't have a financial statement audited of the company itself, because RIAs get in trouble if they're underfunded. They don't stress test their companies. So when the market goes down, their income goes down, they get in trouble. And you want to make sure that your advisor uses a third-party custodian so they don't have direct access to your money. That's what Madoff and other people that have absconded with money had. They actually had custody of the money, and that puts you, as an investor, puts you in a lot of danger.
Because they could take off with it.
They can take off with it and send you a fake statement.
Now, you got to have strong ethics to not abscond with 12 million or 12 billion. Because again, I mean, that's it. That's all you need ever. You could literally disappear, change your face, and there'd be on American Greed.
I remember my dad, when I was little, we were at a Woolworths in West Virginia, and at the back of it, you had all the nice little trinkets and the little pocket knives behind glass. And I said, Dad, why do they have it behind glass? You told me most people are honest. And he said, well, it's make sure they stay honest. And so you want to have precautions, and you want to have things that keep people honest. And that when the audits, the third-party custodian. So if you send somebody a statement that says this is how much money you have, your custodian sends a statement also. You're going to make sure those match. And if they don't match, then you got a problem.
See, these are the type of things why people need to read your book, start following your ass, because you know these things like they're these are duh for you. And everybody else, I'm thinking like, I need to be taking notes here in a minute. I should be taking notes. I'm pissed that I don't have a pen, because again, dude, just because I make a lot of money doesn't mean I know how to invest. And there's people listening to this show that make a lot of money. There's people that make no money. So you'll get a mixture of people. But at the end of the day, just because you make a lot of money doesn't mean you know how to invest. Would you agree?
I absolutely agree. We call it attribution error. You don't have it, but you'd be shocked by the number of people that say, well, I'm successful in one field, therefore I'm automatically going to be successful in another field. And as a successful entrepreneur, it's easy to think, well, I built a company, obviously I understand business, so now I'll be able to pick out the best stocks and know when to get in and out, and I'll know these other things. And I tell people, it's like, just because you're a brain surgeon, you think you can read a manual over the weekend and fly a 747. It's extremely complicated. There's many, many details. There's 80 years of academic research. It's not simple. And quite frankly, if I didn't have direct access to talk to the people that did the studies, it would be almost impossible to apply, because the books themselves are nasty. I mean, they're just one formula after another, after another, after another. It's very advanced math. So without direct access to the people, it'd be hard to apply.
If you were sitting in front of Warren Buffett right now, what is 2 things you would ask him?
I'd ask him, why have you been underperforming the S&P for so long now? Because he did really well early on, but he's had a very long period of time where his numbers haven't even been good as the S&P.
Not many people even know that. How do you know that?
It's my job. I got to know it.
But are you watching his ass?
Well,
does everybody that has an RIA watching Warren Buffett?
People always, when you tell people it's impossible statistically to beat the market, people will throw up certain things in your face. Well, what about, NVIDIA, or what about Apple, or what about Warren Buffett? Well, yeah, there's always going to be a Warren Buffett, but it takes to know whether or not it was skill or whether or not it was luck.
Time
and luck. You would need over 80 years of data to know whether, with something I'll call T-stat or P-stat, it's to know statistically, could it have been random? Could he have just have gotten lucky? And if you look at his numbers and you look at the time period, there's no way to discern what he did from random luck. By the time you would know, the person would be dead, which he obviously is pretty close to being dead. And he just resigned as the CEO of the fund of his company. So
did that lower the stock?
I didn't watch it.
I thought he was considered to be the most successful investor of all time.
Some people would say that. I wouldn't. I'd say he's one of the luckiest investors of all time.
So, Warren, we'd like to talk to you next. This training software that I was talking about, I always said if I could get one person on this training software, I'd want it to be Warren Buffett. Why? Well, because first of all, everyone would buy it. Like, just because of his brand. Like, whoever's doing his PR is brilliant.
Oh, he's got a great brand. Then he gets all those people to go to Iowa and 80,000 in that stadium and everything.
And then I thought it was a fact that he was the most successful investor of all time. Is that not a fact?
Benjamin Graham he studied under Benjamin Graham. Benjamin Graham, on his deathbed, even though he wrote a book on how to pick stocks, said that he believed that the market was so efficient that efforts to beat the market were no longer worthwhile because you wouldn't beat the market any more than you would by blind random luck. So if you look at Warren Buffett or you look at many other managers, and I know people love him, and it's almost heresy to say, but you can't discern his performance, especially in the last 15, 20 years, from a monkey throwing darts at a board.
Dang. So if I was Warren, you would have said to me, why are you underperforming in the S&P?
Yeah.
And then what would the second question be?
I don't think I'd ask him another one. I mean, that says it all.
What if he said, well, Mark, I'll tell you, I was eating my Burger King and living in the same house I always live in. And, he's the opposite. Like, he doesn't have a big fancy house.
Yeah. Well, good for him.
Do you think, yeah, I'd be more on the other side. To me, people just assume because, he's one of the richest in the world. Well, he's probably doing better than you because he's got hundreds of billions. You only got 12.
That's
what
right.
would you say to that?
I'd say That
and can I say something before you do?
Yeah.
He's also 20, 30 years ahead, which means, because again, I want to point out the compounding interest. I was reading something, and I don't know if it's true because you never know what you read is true or not. I read that he made most of his money in the last 20 years, 30 years because of compounding interest.
Compounding interest. Well, I would say what my dad always told me about size. He said, if bigger was always better, Miss America would weigh 450 pounds. So just because you're bigger, just because something's bigger doesn't.
I like your dad.
Doesn't make it better.
Is your dad still alive?
He is.
What's his name?
He's 85. His name's Joe.
Sounds like we should get a book from him coming out. He's got some good advice for you. Was he always a good advice giving guide and leader in your family? Yeah,
he always has been. He's always been my greatest coach.
Sounds like you were raised correctly.
I was taught to value hard work. It would snow in Cincinnati where I grew up. All the other kids would get out of school. They'd go get their sled and go sleigh riding. My dad was like, here's your shovel. I'm like, but I'm out of school. He's like, no, you're going to go do the snow for everybody on their sidewalk and their driveway. And sometimes I get paid. Sometimes I wouldn't. Sometimes I get a hot chocolate. He would say, work, and this is something I think is really missing in America right now, is work is its own reward. Work creates character. It creates a sense of self-worth. It creates value. And he was always a believer in really hard work. He was also a big believer in, he would always tell me, ask the right questions. I'm like, what the hell is that supposed to mean? He said, well, think of it this way. My grandfather, who grew up in West Virginia in the coal mines and the chemical plants, never got out of the mentality of being entitled, being a victim. And my dad would always tell, I said, how'd you get us out of West Virginia? And he said, well, I asked the right questions. If I asked, why am I doomed to live in West Virginia? Then my life would have turned out in that one way. He said, I asked the question, how can I escape these hollers and how can I create wealth for myself and my family? And that led us out of West Virginia to Cincinnati. And he also taught me entrepreneurship, that there's no greater joy in life for a business person not to work for a Fortune 500 company, but to create your own company.
That's what I try to tell people every day. Like I'm like a miniature version of you when it comes to not investments, but like success. People think I'm way more successful than I actually am, which I don't correct them. I just let them think what they want. But they ask me these things and I say, step number 1, get in the position to receive commission. What are you talking about? Like, dude, get out of the cubicle, quit your job. Oh, I got bills to pay. Their mentality is like, it's impossible. When in reality, I think it's impossible working in a cubicle your whole life.
We are so lucky to live in this country where we have free markets. Sometimes entrepreneurs have a bad rap. They say, they're greedy or they're, that's the only reason they do what they do. And I know a lot of entrepreneurs, a lot of very successful ones, and money is one of the last things that motivates them. It's the ability to create and express themselves like a painter would paint a picture. Well, an entrepreneur creates a business and it's an extension of their art and their self-expression in life. And if they're really good at it, they'll create value for other people. And my dad would always say, I can tell you how much value you create for other people. I'll just look at the top of your tax form. And how much ever money you make, that's how much value you created for others. And so he really beat into me. Nobody owes you shit. Nobody owes you anything in life that you don't earn for yourself. Never feel sorry for yourself. Never be entitled. And go out there and stop whining and bitching and create something of value for other people. And if you do that, then you'll have a great life.
Yeah, solve problems. Now, what is your average historical returns on your investments?
Well, it varies dramatically based on how aggressive the model is. So for an aggressive model, which is 95% stocks, diversified globally all over the world, historically we've gone from $1 million to over $11 million in an aggressive count. So that's 11 times in 34 years. But that's a very, very aggressive portfolio. A lot of our clients are maybe 50-50 because they're maybe in their 60s and they have half in equities, half in high quality short-term fixed income. So what that allows them to do is really be able to sleep at night, and it allows them to take advantage when the market crashes. So in 2008, 2009, the S&P was down 50%. Well, if they have high quality fixed income, that didn't drop at all. In fact, it was up. So I can then rebalance the portfolio, sell that off, buy it while it's low to rebalance the portfolio. And that's the tremendous benefit. So a lot of our clients have some high quality short fixed income in their portfolios. In 2000s, when everybody remembers the plague, if they can't remember 2008, 2009, they can sure remember 2020. In that period of time, the market was down 30 to 45% in one quarter at the beginning of 2020.
Is that because of Biden?
That was that was the plague, so-called. That was COVID. But Biden didn't do anything to make it better. That's for damn sure.
Well, dude, the COVID thing too, that was also weird to me. Like, everyone was basically laid off, but yet there was lines out of Louis Vuitton and Gucci, and like everyone was making money hand over fist. How was everything down, but everyone was making so much?
Well, it was down, if you looked at it from an investing perspective, only for a very short time. Because it went down at the beginning of 2020. But then by the end of the year, small cap stocks, value stocks were up 50%. So they went 45 to 50% up in the last part of that year. Most people forget that because a lot of them panicked when it was down. That's why market goes down, because a lot of people are panicking, following the herd. Selling, panicking, getting out. Remember the death clocks, 1 million dead, 2 million dead. I mean, every single TV was rimmed by the death clock, and the people that had it and people that were dying from it. And it was legitimate. People were dying.
Well, people are dying every day.
Yeah.
Those death clocks were a bunch of bullshit. Don't you think?
I don't know what the real numbers. I do believe that there were a certain number of those people that died that did not die from COVID, that died from other things that they had going on.
Well, that's been proven.
Probably would have died anyway.
Yeah, that was... I don't want to get into that conversation because I want this episode to get out there. But I can tell you, dude, I don't buy half the shit that they were pulling, thankfully. So you came from the haulers, you say. Now, when I think of the hauler, I think of a little dirty-faced, snot-nosed kid with mac and cheese and barely any food. And if you got some, it was rabbit that your dad found on his way home. It doesn't sound like you were raised that way.
Yeah. Well, my dad and mom grew up in the holler.
Like straight poverty.
Straight poverty. My dad grew up by the railroad track. They had meat one time a week. It was chicken on Sunday. Other than that, it was beans and potatoes. They had one pair of shoes per year right before school started, and then they outgrew them and they were barefoot during the wintertime. They had their presents were from the Salvation Army for Christmas. By the time they got me out of there, I was born there next to the holler. But even in Cincinnati, when we moved there, we had I just looked it up on Zillow. It was 1,100 foot square house. I mean, it was very, very modest. We were not high level income when we moved out there. And we stayed in the lower to mid class up until probably when I was in high school. And then we got a little bit out of that. But the real success didn't come until later.
Did you ever go back and look at where you came from?
It's terrible. I expected, in fact, several years I went back there and I expected it to have been changed for the better. But West Virginia hasn't really changed at all. I mean, it's just as much poverty. And it's not just the poverty, it's the way a lot of people have given up. My mom would always say, it's not a sin to be poor, but it is a sin to be dirty. And if you go back in those hollers, you see the trailers and you see just rusty old crap they threw away and couches on their front porch and just poverty and people having given up. Like, it's not, they're not in jail, but they might as well be in jail because their mental screens by the way they see the world just keeps them stuck right there.
You ever feel like going and dropping off a bunch of books because there might be one little Mark Matson running around right now.
I should do that.
6 years old that doesn't even realize like he could get out of that.
I haven't thought about that, but that's a great idea.
Yeah. I mean, I'd want to do something like that.
That's a great idea.
I came from blue collar, meaning, we weren't so poor we only got one pair of shoes or anything. I always make jokes that my dad, because there was 5 of us. My dad was like a mill worker, didn't have a lot of money. So when Christmas came around, one year we didn't have anything. He didn't have any money to buy us anything, but he was very innovative and he cut a hole in my pocket just so I'd have something to play with. I said that once at a conference. And this girl came up afterwards. Me and my wife were walking through and, everyone was coming up, can I take a picture and this and that? And you feel like a rock star at these things. And so then this girl's walking up and I thought she just, wanted a picture and her lip was twitching and she was, looking like, I didn't know what was going on. So I'm like, hey, how you doing? After a bunch of people want a picture. So I was being all full of myself. I'm like, you want a picture? She goes, because I told that on stage and she apparently didn't like that at all.
Did you crash her safe space? Is that what happened?
It was something like that. And so basically I just said, have you met my wife? And then I turned and started talking to someone else, but my wife had to deal with it. But she was not happy about that joke.
Was she triggered?
She was triggered.
She was triggered.
Do you find that a lot of the woke goes broke? That saying? Mm-hmm. Is that true in the investment world?
Well, it's hard to predict which company is going woke next, but I would definitely not recommend it for a business strategy as an entrepreneur. I always tell our employees we worked straight through COVID. Of course, we were one of the exceptional. If you're in the finance world, you were allowed to theoretically go to work. But I told all of our people, if you have COVID, stay home. But if not, you show up for work. But also like on diversity and equity, I tell our employees, I said, look, if you want diversity and equity, the best way to do that is hire the best people. And if you're always hiring the best person, you will by nature end up with a very diverse, set of employees. And I also tell them, if you work for me, you're not here because of the color of your skin. You are here because you're the best, absolutely best person that I could find. And that creates a culture of performance. I always tell them, look, we're looking to be SEAL Team 6, not the View. And so, I'm very conservative. I believe in free markets. I believe in capitalism. And a lot of those things, a lot of people don't believe in. Many of them are the woke people, the blue-haired people.
Do you ever get people withdrawing their investment with you because of statements like that?
I'm sure. Yeah. I had a guy.
What would you say to them?
Good luck. Good riddance. I always tell people, look, I had an advisor up in, I think it was Connecticut or Vermont up there. And he had like $70 million. And he said, when Trump, after Trump got shot, I was like, I just can't stay. The guy took a bullet. You had Dana White, you had all these guys coming out for him. And I'm like, I just can't do it. I can't stay silent. So I went public. I went down I gave him $100,000 for his campaign. And I have pictures of me and the wife and the kids, 2 of our kids down there with him at Mar-a-Lago. But I always tell people, look, I would never not do business with you because you're liberal. I'd never say, oh no, you're liberal, I'm not going to do business for you and try to help you fulfilling your dreams. So if someone is that petty and that insecure in their beliefs that they would not work with someone who believes in capitalism. And the other thing is, why would you invest in stocks at all if you're liberal, socialist, Marxist, and you don't even believe in capitalism to begin with? And what I've discovered is...
Because you're a hypocrite.
Because you're a hypocrite. Even liberals, even woke liberals that say they're communists, they want to make money. So if they want to make money, then we got to... I always say the American dream is for everybody, but you got to want it. And if that costs me business, then it costs me business.
You're true to your values.
I'm not going to say so. Some people hate the American dream.
Why do you think that is?
Because it's the American dream is built on meritocracy. It's built on everybody should have the opportunity to have wealth and prosperity, but let's face facts. There are some people that are lazy. There are some people that are drug addicted. There's some people that, aren't just born in the hollers, but there are some people that don't create any value for other people. And if you don't create value for other people, why would you expect to have money for you? And so it's easy to fall into. I had when I was very young, I was 32 years old, I started having pain in my hips. And I'm a cyclist, and I went to the doctor. He said, "You have osteonecrosis." I said, "What? I don't speak Latin. What's that mean?" He said, "Osteo meaning bone and necrosis meaning death." I have bone death? He said, "Yeah, in your hips." And I said, "Well, give me a pill. Let's fix it." He said, "Oh, no, that's not what's going to happen. It's going to get worse and worse and worse. And finally, probably within a year, you'll be 33 years old. We're going to have to go in there, cut him out, put in artificial hips." And I'm thinking, why me? Why me? I'm feeling like a victim, entitled. And I went to a blood doctor, and in his office, he had 10 little kids hooked up on chemotherapy. And I thought, Mark, you asshole. Why not you? Why not you? You don't get to live a life without suffering and pain. Look at these poor little kids. They're playing color books and playing with their trucks and stuff. And so I went from saying, why me, to why not me? Stop being a victim. Go out there and do something.
And what happened?
I had the surgery. I said, that's it. I'm going to go have the surgery. And now I'm 62. I've had them for 30 years. I cycle, I lift weights, I run, I play with my kids. I have a blessed life, and the technology is incredible. Another thing that we have in America as a result of the American dream, innovation, creativity, technology, is we have the highest quality of standard of life on the planet. I'm very grateful for that.
This American Dream book, Experiencing the American Dream audio, obviously hardback, go get it. It says how to invest your time, energy, and money to create an extraordinary life. Give me a 5-second breakdown on how to do that.
First thing, which is counterintuitive for a guy that manages $12 billion, is to recognize that money cannot make you happy. There is no amount of money. I've known a lot of people with tons of money. No amount of money can make you happy because there's someone that always has more money than you do. So the reality is that the money can't make you happy because people end up comparing it to other people. So no matter how big your boat is, how big your house is, how big your company is, that alone cannot make you happy.
I would beg to differ.
Well, I've known a lot of people with tons of money.
Well, that's because they're not happy.
As a matter of fact, money can actually do the opposite. If you look at people with tons of money, there's so many I can't even mention. Elvis Presley, Prince, Marilyn Monroe, Howard Hughes. As a matter of fact, money can be a factor of actually making you miserable.
Could be, and often is. But it's not the reason you are. Just like I think, you give me $1 billion, let's test your theory.
Yeah, well, all the studies
Tell your investors, hey, we go up, we go down.
They have studies of people that have won the lottery, hundreds of millions, versus people that have lost their legs. And a year from the event, the people that won the 100 million were no more happy than the people that lost their legs. So
that's because they lost it. You really believe that no amount of money can make you happy?
No, I absolutely believe that. 100%.
Do you think it's easier to be happy with money?
No, I don't. I believe it's what you do with your life and how you serve others and make a difference for others, not how much money it makes you.
Well, again, there's truth to what you said. However, I also push back a little on no amount of money can make you happy.
If you're a miserable person and you give somebody $100 million, it's not going to make them happy. You're still a miserable person.
If I were a miserable person because I was broke and you gave me $100 million, I would be happy.
Yeah, but there are people with no money at all that are extremely happy.
Only because they're stupid.
No, well, there's people like Gandhi, Mother Teresa. There's tons of people.
They had tons of money.
Gandhi had nothing. He had zero. He had zero money.
And he was
He lived in a loincloth.
He was happy.
Yeah, he was happy.
Come on. Did you talk to him?
He freed a whole nation.
Well, I see what you're saying, but in reality, though, I also push back a little. Why? Well, because I've had no money and I've had some money, and money seems to make things easier.
Well, it might make things, well, not necessarily.
It does for me.
You have 80 employees. Now you got to make sure you take care of 80 employees. You have $12 billion that you manage. Now you've got to make sure that you have the responsibility of managing the $12 billion.
Well, for me, it would be easier to manage your $12 billion than mine. Because if I lost yours, well, it's yours. It's not mine. But at the end of the day, I would be the type of guy that if I'm telling you to invest with your $12 billion, I'd have my money in there too. Yeah. And I assume you do, don't you?
I do.
So you have the same amount of money, or not the same amount, but you have all your money in the same type of investments?
Either my company or the same investments.
Yeah. So that's because you.
And then personal properties, things like that.
But that's what you believe in. Yeah. So
but check it out. So I've been very, very rich. And when I went through my divorce many years ago, I was very miserable. I've been very, very poor, and I've been very, very happy.
Yeah, me too.
So there's not a there's not a correlation between how much money I have and how much happiness I have.
I would agree.
The relationships trump the money.
That's a fact. I've said that every day. But I've also, when people say more money, more problems, that's not true. It's not true. Do you think that's true?
Depends on the situation.
Well, there's always a depends.
Yeah.
But to me, if I took all your money away,
I don't know about problems, but I would say the more money, the more responsibility.
Sure.
And for some,
especially if it's other people's money.
And for some people, that responsibility feels a lot like stress and anxiety.
Well, for you to handle everyone else's money, that's got to be stressful. Because if you lose it, man, you're screwing a lot of people.
The thing about the stress part of it is it's not just managing the money, it's helping them manage their emotional state. That's more stressful than actually managing the money. The money is just straight math and science, but helping people manage their emotional state and being able to stay disciplined, that's the hard part of the equation.
Well, only because I want to get back to this before we run out of time. I want to know the quick version of this so I can take some notes. But I think if you have problems broke, you'd probably have problems with money. If you're happy broke, you'll probably be happy with money. I don't think money causes you problems. I think money gives you more choice, more options, more freedom, more access. And I think if you're a good person without money, you're going to be a good person with money. Because I've had both.
Yeah.
And I prefer money because of the options. It's not because it makes me happy. Because I mean, again, if someone goes, Brad, does money make you happy? Well, it depends on how you define happy.
Right.
Because if right now I had $10,000 in the bank, I'm having a new baby, inflation's going crazy, my car's about to break down, and you said, Brad, you know what? I like you, dude. Here's $1 million. That'd make me fucking happy.
It would create less stress.
It would make me happy. It would make me happy. I would leave here happy. I'd be like, oh my God, dude, this was unbelievable. Like, I'm so freaking happy.
It wouldn't last.
Why?
It wouldn't last.
It may not last. But it would make me happy. It would make me happy.
It would be a quick jolt.
And I'll bet you there's people listening going, me too, Brad. I'm with you.
I know.
Because money can make you happy.
Temporarily.
I think what people mean when money doesn't make you happy, what they really mean, and I'm thinking you too, is it's not solely responsible for happiness. Because I agree with that. Yeah. But dude, money will make me happy.
Temporarily.
Give me $20 million and see how happy I get.
Let's say
I will be happy. I will be happy.
You got a choice. All your money or your wife dies. Which one you take?
Well, obvious.
Right. That's what I'm saying.
I give her a good funeral.
Your wife makes you happy, not your money.
I give her a good funeral.
Oh, no.
I'm joking. She already knows I'm joking. That's why I say relationships, which you pointed out.
Relationships.
Someone the other day, I said, what's the number one thing for you? He said, health. And I said, why health? He said, well, because if you don't have that, dude, everything else is worthless. He thought health is a great answer. And he goes, what do you think? I said, well, I think relationships. He goes, not me. Because if you don't have your health, what good are relationships? I said, well, let me ask you a question. If you had to pick your health over your kid's health, who would you pick? He goes, well, obviously mine. So, I mean, in other words, the kid would have good health. I'd take the disease.
That's right.
Well, then that's a relationship you're sacrificing for. Right. So relationships is the top dog. Yeah. Health then is pretty important, but money's up there. Money's up there. And I tell people all the time, quit being ashamed and quit believing that money is not going to make you freaking happy, because it will.
Here's where I draw a line on that. And I agree, if you're destitute poverty and you get some money, you get out of destitute poverty, you're going to feel better.
You're going to be happy.
But I'm a watch collector. I also collect cars. I also have a house in Montecito. I have a very nice house in Scottsdale, Paradise Valley, Arizona.
No wonder you're so happy.
But another Rolex won't make me more happy. Another Ferrari will not make me more happy. I'll enjoy it. It'll give me a quick buzz, and I'll go and I'll walk in my garage and say, "Oh, I got this Ferrari next to the Superfast," but it won't make me at my very core be any more happy with my life.
I agree with that because you already have them.
Of course.
But if you had a beat up old freaking Honda Accord,
which I have,
and now you got a Superfast, are you happier?
No. I'm happier because of my wife and I have a great relationship, and my kids and everything like that. And I got great ability to have a lot of great people that I work with that are extremely creative, and that's all wonderful. But there's days where I think I walk into the office. Elon Musk said, which I believe, is that being a CEO is a little bit like chewing glass and looking into the abyss. The abyss is that no one knows what's going to happen in the future relative to the viability of your business. And the chewing glass is that as the CEO, every single nasty problem that nobody else can solve comes to me. So I get all the hardest, nastiest problems in the company, and then have to constantly look into, okay, with AI technology, with robo-advisors, with online gambling, with money, there's threats that every entrepreneur has to be aware of, and then create a system to go through that. Or you just throw up your hands and sell and cash out, which is not what I'm going to do. I'm in this forever, as long as I'm can fog a mirror.
Do you hope that in 20 years you're known as you're already known pretty well? Again, for folks that haven't heard of him, look him up. He's not new. But, if I said, name a famous investor, they'd say Warren Buffett. They'd say somebody else.
Yeah. I don't expect.
Do you want to be that, in history when it's all said and done, that Mark Matson was one of the best investors of all time?
I don't expect that. And here's why. 34 years ago when I started the company, I wrote in my mission statement that I wanted to transform the industry, meaning the whole industry would stop speculating and gambling with money. And then what's happened is over the last 34 years, it's only gotten worse. There's more speculating and gambling. There's more emotional pull with the internet and with 24/7 cable programs to tell you that you can predict the future. There's more shit in your pocket where you can gamble and speculate. Robinhood right next to DraftKings. So it's gotten worse. There will always be somebody, somewhere, who gets massively lucky. They will be the ones that are remembered. So I don't think that would be me. It's not even my goal. I want to help people fulfill their American dream, prudently invest their money, stop speculating and gambling, focus on what's really, truly important to them, and provide a successful investment experience for their next 20 or 30 years to fulfill their purpose in life. And that's, if I was known for something, that's what I'd like to be known for.
So real quick, the time, energy, and money to have an extraordinary life. I won't interrupt anymore. Tell me the five, like however many there are. How do I do that quickly?
Number one is ask the right questions.
Ask the right questions.
You got to ask really powerful questions. Number two is develop the screen of the American dream. It's actually very powerful if you see the world as full of opportunities and acknowledge all the freedoms that you have and live in a reality where, you can live in that victim mentality if you want to, but live in a reality where if you help enough people, you're focused on creating values for others, that you can fulfill in your American dream. You want to make sure that you take massive action. So many people, they'll have a dream, but they say, there's a guy at the gym, I hate him, this guy, because he's always saying, Mark, it's the little things. I just want to punch him in the face. No, it's not the little things. It's taking huge, massive action to forward your purpose in your business and your life. That's what's going to make the difference. And academically invest. Stop speculating and gambling and use academic investing principles.
Where do they learn those?
Well, they can learn from me. I'll teach them. Buy the book. Listen to the audio. Come to our 2-day workshop.
Yeah, that workshop, by the way, let's talk about that because there's probably a lot of people that might want to go to that or will definitely want to go to it. It's called the American Dream Experience.
That's right. Yep.
And where is it normally?
I lead, we do it all over the place, but the ones that I lead are in Scottsdale. And we also have a virtual version that we do. It's a 2-day workshop. It helps people understand, break through the no talk rule. A lot of people, it's taboo to talk about money. Discover what their purpose is, understand what speculating and gambling is, understand what Wall Street's doing to you that you don't even understand, know how to use the academic principles to invest, learn how to look at your own mind and your own biases, your own emotions. Vast majority, we have neuroscientists that help us develop the class. The vast majority, I know everyone wants to think that their prefrontal cortex calls all the shots. 90% of our behaviors at subconscious level, and then we try to think up a reason of why we did what we did. So we teach all of that. We also help analyze people's portfolios to show them. Most people you say, is risk is important? They go, yeah. I said, well, do you know how much you could lose in any 2-year period with the portfolio you created? Well, no. I said, well, do you think you can control something you don't even know how to measure? No, I don't think so. So I created something called the 20 must answer questions. These are the questions that every investor needs to understand when they invest their money. And if they don't understand those, they're going to end up being a sucker to somebody on Wall Street.
Ask me a couple of them.
Do you know the expected rate of return of the mix of assets you have?
No.
Do you have a scientific way to measure the volatility of your portfolio?
No.
Do you know what the worst 2-year period could be for the mix of assets you have?
0. Or below 0, yeah. Actually. Would you be able to teach me that?
Yeah.
So when I'm done, I could answer these questions.
Yeah.
How do you know?
How do I know? Because it's
you
science.
Can't predict the future.
No, but I can look at 80 years of data and I can see the volatility of that mix of assets through both good times and bad times.
So why does the guys like Grant Cardone just go all in on real estate? How come he's not diversified?
That's his business. I don't view real estate as an investment.
It's an asset class.
If you go out and start buying apartment buildings, you better know what the hell you're doing. If you're going to buy shopping centers, you better know what the hell you're doing. It's like running a business. It's not passive. Like when we invest, we're in 27,000 different holdings in 78 countries. You don't have to worry about what's happening to the rents in the area of town that you have your properties in. That's, real estate's hugely profitable. That's how Trump made a lot of his money. But boy, you better be good at it. And you better know what the hell you're doing. It's not a passive thing where you just throw some money out and hope.
So if someone threw money into your firm, you're doing what you're preaching. You're not going picking and speculating. You're just buying
We're buying whole segments of the markets that then have dissimilar movements so that, if large U.S. tanks, you got, for example, this year, large U.S. stocks are up 9%, barring today. And international large stocks are up 37%. So what you want to do is be smart enough to diversify so that you have dissimilar price movements. Long term, they might have the same expected return, but if you diversify properly, they're going to offset each other. And that's going to theoretically lead to much higher returns with lower levels of risk. And that's how you build your portfolio.
Is there ever an option or possibility where the U.S. market just crashes and everyone's screwed?
It'll happen.
You think it'll happen?
It's not a matter of, if, it's a matter of when.
So one day the stock market's going to crash like the Great Depression or even worse.
I don't know about the Great Depression. I mean, that was an extreme outlier. But if you look at the market in general, just look at the S&P, 3 out of every 4 years it's up. On average, it's up 20% those 3 years. On average, 1 out of every 4 years it's down. It's down in the ballpark of about 11%.
But those are easy swings to deal with.
Those are easy swings to deal with, but you also have to be prepared for the outliers in the 5 or 10% range, which looks like a 50% drop. And if you can't take a 50% drop and stay disciplined and rebalance, then you have no business in equities, because it will happen. The problem is everybody right now is living in a delusion. The delusion is because things have been good for the last 10 years. But I always tell people a ham sandwich could make money over the last 10 years. The S&P's up almost every year. Tech stocks are up every year, just like they were in 2000. From 95 to 2000, the S&P was up 22% per year for 5 years running. Tech stocks were up 45%. Everybody was 10 feet tall and bulletproof, heavily invested in all U.S. large and tech. Tech stocks lost 75%. The S&P lost 50% after that. And most people were completely unaware that it could happen. Same thing could happen today. And most people are not prepared.
Did you say will happen?
Eventually it'll happen. Crashes happen.
So what is one to do? Just stay tight and buy more?
Well, the first thing you have to do is build your portfolio so that you can live with the risk. And if you're looking at a 40% drop in the data, which you don't know when that'll happen, but if you're looking at the data, you have to ask yourself, honestly, can I live? Does that meet my sleep factor? And can I live with it? And if I can live with it, then I'm fine. But if I can't, then I need to add short-term high-quality fixed income. So if I put half of my money in high-quality short fixed income while the market's dropping 50%, my portfolio is only going to drop 25% theoretically. And now I can handle that a lot easier if you're an investor that's afraid. And then you can use the fixed income to rebalance and buy more stocks while it's low. So it's all your risk tolerance. And I've had some investors that are 85 that are 100% equities. And I've had some people that were 25 that were 75% fixed.
Which one's less volatile?
The fixed is much, much less volatile because you're having much more high quality short-term fixed income to offset the equity volatility.
Why doesn't you put 100% into that?
Well, because if you're a 30-year investor like you're going to be, if you're a 30-year investor, you got plenty of time to see it come back. In my portfolio, I'm 100% equities, 95% equities.
For what purpose?
For retirement, theoretically.
Don't you have enough already?
I do. But I still have money in equities.
When do you stop worrying about investment?
You stop worrying when you pick a portfolio that you can live with no matter what happens.
Because I know one day I'm going to liquidate a few things. And I always say 100 million, could be more, hopefully. But I think, with this 100 million, and I'm talking out my ass because I don't know shit. I'm going to, though. I'm going to read your book. I'm going to start following you. I'm going to start paying attention because I'm way too old. I should have done this when I was 30. But my dumb ass didn't understand. I just didn't understand. Now I'm starting to understand, it's almost like I'm thinking, I better hurry the F up. Because, dude, making money is one thing. But if something happens and that ends, well, now what are you going to do? You're going to go from living up here to living down here. You're going to lose all your shit, and you're literally going to be broke. Where if someone would have invested and didn't live so high on the hog and would have just maybe medium on the hog and invested intelligently, well, that's that stability that I'm looking for now. So to me now, I think I have a good 5, 10 years, maybe 15 years of earning. But I think eventually that earning potential is going to drop and I need to have investment earning.
Yeah.
And that's what I'm looking for. So where I liquidate, let's say I get 100 million and I say, here, Mark, there's 100 million. I want to live on that interest, not the principal. I want the principal to keep paying my kids and their kids. And I want to make it to where nobody can ever take the principal. They can only take the interest. So how much do I need? Because if you say, well, 1 year you could drop 40%, well, then that means I lost 40% of the principal.
That's right.
Well, then I didn't have any interest and I didn't have any money.
Well,
so what do I do?
But the way to do it is you don't want to look at it as I'm going to take interest.
Well, how do I live then if I shut down all my businesses and sell them all?
You theoretically, what you do is, and let's say it's $100 million, and you say, okay, I'm going to take the statistics say that if you build a really great portfolio and you're able to stay disciplined, then you can take on the ballpark of about 4% per year and still have the money grow and stay up with inflation. So your $4 million per year of income, plus as it grows, in 10 years, it might be $6 million. In another 10 years, it might be $8 million. So what you want to do is you want to build your portfolio. Now, if it's down, then whichever asset category, if you're international and US, you're managing your portfolio, you're taking the one that's relatively up. But you don't want interest in dividends because that's 100% taxable. You'd rather take capital gains because capital gains are only 20%. So if I'm going to take $4 million in its interest per year, now I'm going to lose half of it to the government. Instead, better to take capital gains from the portfolio and only pay 20% instead of paying 39%. And then stay disciplined no matter what happens and continue to stay committed to your portfolio even when it's down. Because you can take money from the portfolios while it's down because it, in the end, always comes back up. You just got to not panic.
What about, I think they call it infinite banking. You ever heard of that?
No.
You never heard of that?
No.
Where basically you become your own bank. You go get these vehicles where you borrow your own money and they'll loan it to you because if you die, it's immediately
Well,
paid.
They're talking about buying a whole life policy or some kind of insurance policy. That's what you're talking about.
Yeah.
You put your money in the policy. I'm a big believer in insurance, but not necessarily as an investment. Look, if you have 100 million and you die, the tax on that's going to be half. So we talked about leaving it to kids and to your spouse. You can leave 100% of it to your spouse. When they die, though, the government comes in and takes half.
See, how the hell they do that?
It's an estate tax. It's an assault on capital. It's an assault on entrepreneurs. It destroys so many businesses. But life insurance can bridge that gap if you have 30 or 40 or $50 million of life insurance, which is a lot of life insurance. But I don't view that as my personal bank. That's a sales jargon from insurance agents. And I have tons of life insurance, but I don't view it as an investment. I view it as protecting my family and my estate.
So it's not realistic to think if I liquidate, finally get to where I have 100 million liquid, where I can now invest. And by the way, along the way, so over time, I put away 100 million, that 100 million can earn me $10 million a year, no matter what. Every single year, I'm getting 10 million bucks to live on until I personally die. And then once I die, the 100 million remains and the 10 million and growing can then be given to the family where they can live on 10 million and so on and so forth. That's unrealistic.
10% is a huge rate of return.
Really?
Yeah. There'll be some years where you might make 40 or 50, but you can't plan on it.
What can you plan on?
You can plan on 4%.
So 4% is safe.
4% as long as you don't make any mistakes.
But my mistake would be giving it to you or giving it to someone else.
Your mistake would be panicking, either panicking when things were really good. Panicking when things are really bad, or chasing stuff when other things are really good. Like the Magnificent Seven, Amazon, NVIDIA, Apple, Tesla, the big seven stocks. A lot of people are in those stocks. That would be a huge mistake.
Would they call you and say, Mark, move my money over there?
They might. And I'd say, no, we're not doing it because you paid me not to gamble with your money. So if you're going to...
Do you ever get people pissed off that you won't listen to them?
Yeah. But mainly financial advisors. Usually the clients are pretty steady, not always, but pretty steady. It's the advisors who think they know better than the market, who think they can pick and time it. Those are usually the ones that screw it up.
For all the people listening, how can someone identify if their RIA is a full of shit son of a bitch and they need to get their money and move it to you?
Well, if they're stock picking, they told you, I can pick the best stocks. They're gambling with your money. If they're telling you they can predict when the market goes up or down, they're gambling with your money.
Can't they say, based on historical facts, the market goes up when this happens and the market goes down when this happens?
Here's the hardest thing for investors to take into their DNA and their gut. All of the knowable and predictable information is already in the price today. Everything knowable, everything predictable is already in the price. There are way too many brilliant, smart people trying to beat the system. Some people that have spent their whole life just studying Apple. That's already in the price. There's nothing you know as an investor, and there's nothing that some money manager at Fidelity knows as the manager that's not already reflected in the price. That means that only random and unpredictable new events will change the price going forward. And because no one can predict the future, no one can tell you with anything like certainty what's going to happen with the market on any given day.
Unless you're a congressman.
They do have an exception, except the problem is there's actually been studies on insider trading. By the time somebody moves enough money to actually make any significant profit from the trading, everybody knows what these senators own by now. So it's highly reflected in the market very, very quickly. You know, they did a lot of studies. They did studies even with people wearing orange jumpsuits, like Martha Stewart, about does the inside information actually pay off in the long run? And it doesn't.
It doesn't.
Market's way too complex for that.
So what's a person to do? You make it sound like, shit, why even try?
Well, no, the markets, this is counterintuitive. The markets, equities are the greatest wealth creation tool on the planet. Think about it. All the great products, everything in this room comes from capitalism and capital. All the jobs, every single job comes, even the government jobs, come from capitalism and the raising of capital to fund these companies. Not only do all the great services and products and all the jobs come from that, but the returns are huge if you don't mess it up. Historically, large stocks at 10% a year, you double your money, as you said, every 7 years. 12% for small stocks, 12%. And small value stocks, 14% per year. I mean, that's a massive rate of return. But you can't mess it up. You can't get stuck either panicking when things are crappy. You got to eliminate picking and choosing. And then you got to eliminate toxic investments. You and I talked about Bitcoin, chatted about that for a minute earlier. There's no there. When you buy a stock, I own a piece of company. When I buy a bond, I buy a promise from the company that has products and assets to repay the bond. Bitcoin, you get nothing. There's no company. There's no promise. There's no products or services. It's all fairy dust. And it's insane what people are doing. And eventually it will crash. And people... Sure, some people got in there early. The number one guy, one of the number one guys is the same idiot that paid $6 million for a banana stuck to a wall with duct tape. Remember that story? The guy that paid $6 million, he's one of these so-called, Bitcoin kings or crypto kings. It's a joke. It's terrible. But if you get sucked into it, investing is a really interesting phenomenon. In a lot of things in life, you can make a mistake. Let's say you're on a fitness plan, you're working out really good, you lose 30 pounds, you put on 5 pounds of 10 pounds of muscle, you have one bad meal, you're not going to die of a heart attack. That's not the way investing works. You can make a lot of money for many years, make one bad mistake, and you can wipe out 40 years of hard work. The stakes are high when it comes to investing. And if you get sucked into toxic investments you don't really understand, hedge funds, private equity, private debt, Cryptocurrencies, even gold. Gold historically has a return of 5%, just 5%, with a volatility of stocks. Stocks historically at 10%. So double the rate of return with less volatility. But yet when you talk to people, they think gold is a safe investment. They haven't done their research.
Where do you get your research? Do you wake up every day with ticker tape and inbound information?
No. My research, I go to the academics for the research. I go to the University of Chicago, Harry Markowitz, Nobel Prize winners. That's where the real science is being done when it comes to investing.
You trust these guys, huh?
Implicitly. What else is there to trust?
Gut.
I'm not that. I'm pretty arrogant, Brad, but I'm not that arrogant.
Well, like I'll give you an example. COVID came around. I started listening and whatnot, and I found out this guy named Bill Gates actually owns Moderna, and I'm like, that motherfucker. So I bought Moderna stock, and sure enough, went way up.
Yeah,
and I thought, well, shit. And then the rumor came out where, like, you know, it's not working and I sold it and it went. So that was my gut. Bill Gates owns it. He knows something. I bought it. It went up, started getting the rumors. I heard some shit. I sold it. It went down. Now, if it's back up, I don't know. Because when I sell it, I don't give a fuck no more. But dude, I picked it and made it. Now, that ain't a strategy and I can't do it. I can't do it repeatedly, but you only need to do it so many times for it to whack. And I didn't put much money in it, unfortunately, because it went up.
Yeah.
I did the same thing. I did the same thing with, what else was it? Well, again, I mean, even Bitcoin, like I got a bunch of Bitcoin and made money. I bought XRP. It was 63 cents. It's $3 basically now.
Yeah.
So I'm winning. I'm winning with my gut.
People tend to remember their wins. If I went back for the last 30 years and measured every single time you bought a stock or an investment and did a compound rate of return and what your total rate of return has been, then it would tell us something interesting. Anecdotal evidence of when you got lucky and bought a stock and made money on it means absolutely nothing. You know, anecdotal evidence is not evidence, right?
But can't you get?
You need scientific evidence.
Well, like for example,
for every guy that says, "Well, I got lucky, I bought this when I made tons of money." There's a guy like one of the guys in my class had $15 million in Boeing, and he worked there for 30 years and said, "There's no way it's ever going to lose money." Right after he said that, Boeing made 2 airplanes. Well, they made one airplane, and 2 of them crashed into the ocean because they had an autopilot that clicked on that the pilots couldn't turn. They literally made a plane that crashed itself. And then they made a plane where the doors blew out at 35,000 feet. And then they had people coming that were whistleblowers saying that they had violated all these things. That poor guy's $15 million is 7. Never, ever trust your future unless you're just going to gamble and you admit it. Never trust your future to a gut guess, ever.
So then my last question, what are you doing? Like, you got to pick them too.
No, I don't.
Who picks yours?
The research is from the academics that show the asset. Here's a good way to answer that question. The question is, where do returns come from? Do they come from bright managers, really smart managers who can pick the market in advance and beat the market, or where the real returns come from the cost of capital? The cost of capital means that every company has a cost to raise money. The strong, stable ones have a low cost to raise money. These are the Fortune 500 companies. A small company that has a lot of risk has a higher cost of capital. If the academics have studied which types of stocks have risk premiums, additional rate of return, not based on a pick, but based on that whole asset category. If you own that whole asset category, statistically, you have a higher expected return. And if it doesn't work out that way, you definitely don't have any lower expected return than the S&P 500 itself. So the returns come from the market, not the manager. The trick is being smart enough to know where the premiums are and how to diversify that portfolio and create a portfolio that you can live with and then stay coachable for the rest of your life. And if you can do that, you'll come out, your odds of having a successful investing experience will be much greater than trusting a hunch.
And that's what you've been doing for the whole time.
Since 1991.
And it's done well so far.
So far, we're hanging in there at 12 billion.
So for people listening, number one, if they obviously they want to invest with you, you don't have a minimum, you say, or do you have to know someone that you're already managing their money?
One of the great things about the way that we do it is we created a fund-to-fund structure that allows us to help people, even if they're just starting out. A lot of those are relatives of our other clients. But people, the other thing I do, because I believe in it, the American dream, is that we have people come to our workshop and also our virtual class that can attend and learn about these concepts and ideas. We did a very quick version here today. There are people that have spent the last 80 years studying this stuff. So we just 35,000 square, look at this whole thing. Come to the class. Either go to the virtual class, buy the book. It'll help you at least understand or listen to the audio. And if it resonates with you and you want to stop gambling, you go, my gosh, I'm gambling. Check us out.
And then RIAs, other RIAs, how egotistical are they, or do they seek you out to learn better what they're doing?
A lot of RIAs. I just finished a class of new RIAs. These guys, a lot of times they get stuck at 100 million, 200 million assets under management. The thing that got them to 100 or 200 is not the thing that's going to get them to $1 billion under management. They hit a ceiling of complexity. They don't know how to scale. They're mainly doing one-on-one meetings instead of doing one-to-many, having 500 people, 1,000 people in a workshop. So we teach advisors how to do that. But as far as the overall ego of advisors, I would say hi.
Because they all think they're picking, don't they?
Well, I sat in that room in 1991 and had my world rocked by the science of the whole thing. I can't tell you anybody. I couldn't sleep that night. It was like getting gut punched. I felt sick at my stomach because I knew I was hurting investors back in 1990 when I first heard the research. I'm not sure very many people were upset in that meeting.
Why? Because it's their advantage.
They think that well, yeah, it's hard, but I'm so smart. I'm the one that can pull it off.
Yeah, I went to Harvard.
Yale, Princeton.
So RIAs should seek you out if they want to learn how to freaking grow their RIA.
If they're stuck at 100, 200, 300 million, they want to go to $1 billion, they should seek us out. We can show them how to do it. And
then entrepreneurs that are making money and are probably just throwing it randomly into places, even though it might be working, what you're saying is, yeah, it might be working for now, but pay attention. Here's my last question. I keep saying last question. What type of formula am I looking for to invest? So in other words, let's say I have $1 million. That's all I got to my name. Should I be putting 80% in? Should I be putting 10% into this? Like, is there any formula where you're like, because I would have said before meeting you, well, I mean, depending on your risk tolerance, you can risk 10% of it for these high dollar payoffs, these, gambles. Because dude, you got to gamble. Don't you?
I don't.
Well, I mean, you got to have a freaking like a football game. It's more fun when
I'd rather buy a Ferrari than dump $300,000 on some gambling crap. That's just.
But it's not always you. But you could win.
I'm not. Hey,
people win all the time.
I'm a guy that goes with the math.
Well, then how do you explain venture capitalists?
Well,
they're gambling all the time.
Yeah, they are, but that's their business.
I know, but
and let's say that a venture capitalist has a great business model that's going to make 30% a year for the next 5 years. Do they keep it to themselves, or do they sell you the venture capital idea for 2 and 20?
Depends on their how big the thing is.
Well,
eventually they run out of their money.
If it's a 30% guarantee rate of return, they don't need your money. In fact, they would never sell you it for 2%. Why would I sell you something for 2% when I can make 30%?
Well, because you don't have any more money.
You said they're venture capitalists. They got all the money in the world. Ask Michael Milken. Ask these assholes on Wall Street that manufactured the junk bond crash. Behind every theoretical win, there's thousands and thousands of losses people don't take into consideration.
Yeah, but like, for example, I never raised money for this company. I should have, knowing what I know now. Oh boy, it probably would have been $1 billion company already.
Yeah,
but
I would have, could have, should have.
I know, but I didn't know.
That's hindsight.
I know, but I didn't even realize I could have raised money. I thought people had to come and offer it. I didn't know you go raise it. But long story short, I should have raised it. I should have burnt through $40 million, right?
I don't know. You're doing pretty good.
But well, it's all bootstrapped, and I had to. I didn't know about raising money, but I know companies that are valued more than this one in the billions. They just raised $550 million, and their burn is millions per month. They're not making anything; they're burning.
I know.
And then I'm thinking, well, who the frick would invest in that bullshit? Well, guess what? They know that if they burn 50 million by year 4, it'll do this, and then it'll be worth $1 billion. And then they're going to 5x their money.
Yeah. Well, if that's true, they're not going to sell it to you for 1%.
No, I know, but it's still like venture capital. That's how it works. Or like rolling up companies. So if I'm thinking, okay, I got 10 million here, I can go buy, 20 $1 million companies that it's only worth 3x, put them under one set of books, and now that $20 million company is worth 8x. So I just make the gap. So like I pay them 3 or 4, and then I sell them, I bundle them, and I sell them for 8. Well, I just made 4x.
All of that's running a business.
So that's not investing.
That's a business.
So that's not investing.
I invested $30,000 in my business initially. That's all I put in it. $30,000 initially on 3 credit cards. I just recently had it valued for $250 million. Now,
so if you wanted to sell it right now, someone would hand you $250 million.
Yeah.
What would you do with that money? Who would you invest it with?
I would. I bet I'd keep it invested the same way that I'm investing all the other money.
Why don't you do that?
I love what I'm doing. What am I going to do with my time? Play golf? I suck at golf.
What would you?
We're at 12 billion. I want to be 24 billion.
How long do you think it'll take you to get there? Is it just
probably 5 to 10 years?
Is it just attracting more investors?
No, it's creativity. Like, for example, next year I want to create a documentary called "Your Brain on Money," and I'm working with a guy named David Eagleman who does science documentaries. And then we're going to go to Netflix and try to get Netflix, and we're going to the Sundance Film Festival and see if we can win an award. I love creating. I love creating content. I love creating movies. After that, I have a dream to create this thing called the Dream Center. It's for people that want to teach their kids about the American dream, innovation, entrepreneurism. It's an experiential thing, kind of like Disney for families who want to learn about investing. Which would be basically creating more investors. Yeah, it would be able to create more investors. Sure, absolutely would. And I just thought I view, as I said earlier, your business is an expression. I can just walk in here. I know who you are as a man because this is an expression of who you are and the values that you have. And for me, that's a great joy in life to be able to express that way. Far greater than the money. I've had many offers to buy my company up and merge with other companies. Not interested.
Not only that, then you'd have to work for someone else.
Yeah, then I have to take orders. I'm not a very good order taker. My wife can contest that.
So, folks, go follow him, obviously, at Mark Matson 1 on Instagram. He's dropping content left and right. His plan, he's got a whole team now. His plan is just to keep dropping knowledge on you guys. I think you should start a podcast where it's like, I know it's probably a compliance issue, but like I would just start a personal podcast. It has nothing to do with investing. Just
personal stuff.
Just your own opinion, like what we just did.
Yeah.
This wasn't a compliance nightmare, was it?
No.
Yeah. So, I mean, that's all you're doing is you're talking to people and then bring on these academics that most people don't know. Nobody knows these people.
Oh, that's a good point.
So you could just be interviewing the Dershowitz guy or whatever, and so tell me, where'd you learn that? And how'd you learn that? And all of a sudden, dude, you become one of the best known financial podcasts on planet Earth. Mark Matson Money.
I like that.
Yeah. I would start a podcast But folks, listen, I only told him an hour. It's been 94 minutes. This dude's got shit to do. Best-selling author of several books. Go get his book. It's on Audible. Go follow him at Mark Matson 1. And if you got some time, I would be looking into the American Dream. How do people go to these events?
They can go online and register online, matsonmoney.com, and there's a tab for the American Dream experience, and they can learn all about it. They can see we do have exhibits too. I have a piece of the Berlin Wall. We call it the Berlin Hall, and it's all the freedom and the difference between tyranny and freedom, and it's a lot of experience when they go there too. It's not just the workshop.
How many people go?
I can do 350 in my live workshop. I've done as many as 800, 900 on my virtual.
And that's a networking opportunity of other like-minded people.
That's right.
Dude, sounds like you got your dream life figured out.
I'm loving it. I would say pretty extraordinary.
Well, I appreciate you coming in, folks. There you go. Don't say I didn't bring you any knowledge. Until next time, keep it real and quit gambling, folks. Quit gambling.
There you go.